Welcome to our The Planning Center webinar on taxes aren't the problem, lack of strategy is. I'm Matt Sievertson. I'm here with Caleb Erringdale off our tax team, and Caleb and I get the pleasure of working quite a bit on some cases together. So this topic is well versed with road testing of the activity with clientele. And also it happens that Caleb and I both play saxophone, so we are a very musical group at the Planning Center. So I'm going to quick ask Caleb here what his favorite saxophonist is.
Well, obviously, Matt Sievertson is the correct answer to that question.
No, but because,
really, like I like to think I'm a pretty good sax player, but compared to Matt, I am a mere peon. But Charlie Parker is, of course, every saxophone player's favorite player. Like he's just incredible. Kind of redefined the instrument.
Definitely, Charlie Parker's a good one for sure. And then on tenor saxophone, hard to ignore John Coltrane, which would probably be mine. So you're hitting two giants of the saxophone right there.
So what's your favorite ever like classic sax song, like standard?
So classic standard jazz song would probably be In a Sentimental Mood. Just kind of a really good ballad. Sounds great on tenor sax. So one of my favorite ones to play.
That's a really good one. I think Take 5 is just one of the classic songs of all time, but Harlem Nocturne, just for sax ballad. Oh, love that song.
That's a good one as well, for sure. So anyway, switching over to taxes, I will say, why did the taxpayer cross the road, Caleb?
I have no idea.
To avoid the IRS.
I'm giving that two very mediocre applauses. There we go.
All right. Well, here we go. We'll move on to our presentation here. So we are going to cover tax preparation versus tax planning, two very different things, and why reactive tax filing can cost you. We're going to look at some key strategies to act on now, and also kind of break them down in some real world examples that Caleb and I see quite a bit, and then boil things down to some key takeaways, and we'll open it up for some Q&A at the end of the session to get your questions answered. So starting off with tax preparation versus tax planning and why reactive tax filing can cost you. I've definitely been on both sides of this equation before. So from the tax preparation where, looking backward, just everything has happened. There's not really any planning work that's going on. It's very reactive. I've just kind of thrown all my stuff into my tax preparer after the year is over, and then just kind of crossed my fingers and hoped it all worked out. But we all know that can not go as well as we would want it to go. And so the tax planning side, is very forward-looking and really kind of shapes what happens and creates more of a year-round process out of it. And then with that, all of a sudden we can kind of minimize tax liability, and especially surprise, right? I think is a big thing Caleb and I'll see, and really turn it into a proactive process. And then really kind of work to maybe reduce what you owe, right? So not just running from the IRS, but what can we really do to minimize those taxes? So Caleb, kind of on your side of the fence, what do you kind of see? You've seen both types of client. You've worked in tax industry in a long time. Give us your thoughts on these two very different approaches.
Yeah, and a good way to think about it is tax preparation is important, right? Like we have to prepare them. It's a government mandate. We have to, by April 15th every year, either have filed a return or extension, right? So we have to do our taxes. So tax preparation is the given. But what a lot of people don't think about is the tax planning piece of that, because tax preparation is all backlooking, right? Because when do we start? Well, we usually start taxes, for instance, this year in 2026, looking at the calendar year for 2025. And a lot of things have already happened by that point that we can't impact anymore, right? You could have missed certain credits, certain deductions, certain opportunities that if you aren't doing the tax planning in 2025, you've just lost out on. And so I think this graph breaks it down well. It's just recording what happens or shaping what happens. When we do that tax plan, we have the ability to say, hey, what is the best way to lower overall taxation for this year, not only for us, but even for our heirs potentially. And we could say, hey, actually, maybe the right idea is to not lower taxes this year because over our lifetime, that will mean lower taxes. And there are all sorts of things that if we proactively look at it, we can decide what will work best for the entirety of the clients and even their heirs' lives. So being very proactive lets us do that. We work in the calendar year, so that when we actually get to the preparation step, there are no surprises, and we're doing what's best for the client.
Right. And collaborating with a good team is key, and kind of knowing what things to keep on top of through the year. And sometimes it could be a little annoying, like pulling pay stubs fairly frequently, or especially if we're like switching jobs mid-year, right? A lot of times it can be, we got to slow down a minute, right? In the busy chaos of life. But I think if we can kind of do that, right, we've seen people be way more prepared for the proactive planning elements that we can incorporate.
Mm-hmm.
Cool. So some key strategies to act on now. The first one is Roth conversions. We do have a case study. We will dive a little deeper on this, but the main premise of a Roth conversion is taking a pre-tax account and converting it to Roth that will grow tax-free, but having to use after-tax dollars to pay the tax bill. So Caleb, why don't you just give a quick overview as well on what you see with the Roth conversation?
Yeah, Roth conversions are very popular. And especially, I'll say, like the online, the influencer, the finance influencer space, they talk a lot about these. And so a lot of times clients will come in thinking, hey, I want to convert my entire IRA to Roth, or I want to do these really big Roth conversions. And Roth conversions can be fantastic, right? They're an excellent tool. We use them all the time. But the answer to the question, should I do a Roth conversion, is, as always, it depends. Right. So for certain people in certain situations, they are fantastic, but we just have to make sure we're using them in a smart way.
Right. And we can definitely be pretty wired to be tax adverse. So sometimes the notion of wanting to pay the taxes is kind of like, why would we ever do that? But one of the powers of, long decades worth of tax-free growth, all of a sudden we can experience a massive amount of growth that we'd never have to pay tax on again. So that is the pro side of it. But the con is we do have to get over paying the tax bill, and it is very subjective and case by case through those discussions and what somebody's propensity to do that is.
Yeah, absolutely.
So moving on to strategy number 2, tax loss harvesting, with the main premise here being, looking at investments and kind of looking over stuff in your after-tax brokerage accounts to see, are the stocks I'm holding or the funds that I'm holding, are any of them down temporarily where I could sell those and remove them from the portfolio? Or if we're in a fund, can we sell them while they're down and maybe swap to something of a similar profile so that we can keep that exposure but capture the loss on paper? But Caleb, give us kind of your 2 cents of seeing this in real time as well, and kind of seeing the tax forms that generate and what kind of benefits it can have.
Yeah, absolutely. No one wants for their investment accounts to go down, right? I mean, the idea is up, up, up. But when there are market corrections, when things do dip, it gives us a great opportunity to capitalize on this, because when this is done correctly, you're not functionally losing any money, but we're creating this sort of artificial tax loss that we can use to offset other capital gains. And we can even carry that forward, right? That loss forward, until we use it all. So tax loss harvesting is a tool that when things are rough, it's a great tool to take advantage of that.
Right. And moving on to number 3, maximizing our tax advantage accounts. So if we're self-employed or we're employed at a company that has certain benefits, really looking at 401k, 403b accounts, or just looking at being able to do IRAs or even health savings accounts through our employer benefits. And some can be kind of have some flexibility that Caleb can talk about. Others, we might have to really be strategic on our payroll deduction through the year. But Caleb, give us kind of your overview on utilizing these accounts.
Yeah, absolutely. So let's say you're an employee, you have a 401k. Well, you have a maximum amount that you can contribute, right, during the year. And that all really has to be done in the calendar year. So if your contributions, if you want to maximize it and you're not planning correctly, you could miss that number by, $5,000, $10,000 easily. So it's really important to be planning to hit that maximum number during the year. Now, if you have what's called like a solo 401k, or if you're self-employed and have your own sort of retirement set up through your business, then we have a lot more flexibility, and we can even actually make contributions to that after the end of the calendar year. But for these HSAs, 401ks, then we have to do those during the year.
Cool. And then moving on to number 4, charitable giving, another great opportunity. We definitely see IRAs. We could do what's called a qualified charitable distribution starting at 70 and a half. And that can start to switch to use a pre-tax bucket of money to do allowed charitable giving right off the top on that account, and even help offset required minimum distributions when that would happen for somebody at, like, say, 73, 74, 75, depending on someone's birth year. And then also another great strategy we see is donor advised funds, where we can take a highly appreciated asset like a stock or a fund and really push it into an account that creates a wrapper that's completed the gift and can be written off on taxes, but then can be slowly given out of the donor advised fund over time. And then also new this year, we're now getting $1,000 a person, just direct charitable, which is great to see, especially for like smaller gifts and some of these not-for-profits that maybe lost a little bit of giving when some of these tax rules went away. Now we're seeing those show back up again. But Caleb, kind of your take on this whole area and the planning you see with our clients?
Yeah, absolutely. Obviously, none of us give charitably just for the tax benefit, right? Or that's pretty rare. We give charitably because we want to, right? We want to support certain organizations. But if we are going to do that, well, why not maximize the tax benefit? And so doing these qualified charitable contributions, those QCDs, that really is the most powerful thing, the most powerful way to donate if you're above 70 and a half. Otherwise, those donor advised funds are so powerful. So many clients can benefit from those. It makes a huge impact for them. And this new tax deduction, important to remember, this is only for cash contributions, right? So any goods you might donate to Goodwill or something like that are not included in that $1,000. But if you're making like cash contributions to a charity, or writing a check, or whatever, that can be deductible up to $1,000 a person starting in 2026. So that'll be a great benefit.
Right. And then the benefit on the donor advised fund too is if we do cherry pick some asset that's highly appreciated, right? The benefit there is they're avoiding the capital gain on that exposure and giving the full amount into the fund and getting the deduction.
Yeah, that's such a huge benefit. Like, I mean, think about it. You buy a stock at $10, it appreciates to $100. If you put that into this donor advised fund, you get a deduction for $100, and you never have to recognize that $90 of income. It's a really powerful way to gift charitably.
Right. And this is kind of where the term gift clumping came in as well. If there's a year where we're trying to say, let's have a bunch of charitable gifts happen, we could clump that larger gift into the fund, take that in one year, and then certainly give that away over maybe a 2, 3, 4, 5 year period of time, whatever we wanted, but could at least optimize a larger gift with a highly appreciated asset in one given year to strategize with that. So a lot of possibilities there. And then moving right on to number 5 with the income timing, controlling everything. And if, like we mentioned, if there are high income years, well, can we do a big charitable gift to offset it? Can we just make decisions on things to really focus our income from certain assets to maybe avoid a higher tax bracket, or one of the IRMA tables where our Medicare pricing is going to jump up on us? Other little benefits like senior tax freezes. So Caleb, what do you kind of see in real time on this one on a regular basis?
Yeah, there are a lot of credits or deductions that have what we call a cliff, right? So in other words, you go $1 over that amount, you lose it. And a lot of those are for people with somewhat lower income. And so what we make sure we do is say, hey, if this is the situation, let's make sure we stay on the other side of that cliff. Obviously, someone has to have enough money to live on. So we want to get close to that without going over. So these don't apply for every situation, but for the ones where it does, if we can keep someone in a lower IRMA or kind of a lower Medicare price tier, if we can give them some higher health credits, right, through the ACA, or for instance, people in Illinois, that senior tax freeze for their property taxes is so powerful. So if we can keep people in these income bands, it can save them really an outsized amount of money. And so that's through really careful planning of when we're going to take income. Maybe some years we know, hey, this year we don't have a chance of staying inside this band. So let's really load up this year so that the next few years we can stay inside this and benefit from these credits. It's a great way to help people out.
Right. Yeah. Imagine the surprise if you filed your return and say you were $100 over one of those cliffs,
Exactly.
right? It's like, if we just paid a little more attention to it, we could have stayed below that threshold.
Absolutely.
And then moving on to number 6, the safe harbor for estimated taxes. I know this is one as a taxpayer as well. Not only do we not like taxes, but we don't like penalties on our taxes. And so I definitely work with Caleb and the tax team and want to make sure I'm sufficient on this because I don't want underpayment penalties as well. But Caleb, kind of go over the couple methods on this. I know this is a kind of a confusing area for people to understand how to protect against penalties.
Yeah, and this right here is another big difference between planning and preparation, right? If you just go to an accountant and you just drop off your stuff at the end of the year, they'll probably give you some tax estimates that cover one of these, what the IRS calls safe harbor amounts, right? With that, and that can be great, and that helps. That's either like 100 or 110% of last year's taxes, and there's some other rules in there as well. But basically, that keeps you out of this underpayment penalty range. But for certain people, maybe last year was a unique year. Maybe it was artificially low or artificially high, their income. So instead of just basing everything off of last year's taxes, let's look at this year and see, hey, do we need to follow those safe harbor payments? Can we go lower? Do we need to go higher? By proper planning, we can figure out what you actually need to pay to avoid penalty, but also not have a massive refund or massive balance due at the end of the year.
Right. Very key. And then moving on to how investment decisions impact your taxes, the account structure does matter. And I know being financial planners, we like our buckets of money, and then being tax planners, the different tax treatments of those buckets of money. So on this first point, we really have 3 main types of money, and we can have pre-tax accounts where we've gotten the tax deferral and they go in there and they're delayed out and they grow. And then eventually when we draw on them, we pay tax. Then there's the opposite of that with the Roth, where we've paid tax up front, we've moved it into there, and then it's tax free from then on. And then we kind of have our regular non-qualified money, which when we invest, it kind of creates a cost basis with the after-tax money we've invested. But then every year we kind of pay tax on the dividends, the interest, and the gains that it kicks off. And then also there can be unrealized gains that if we do some pruning, can also trigger more gains. So really just kind of having all 3 buckets helps us be really efficient so that we can kind of plan and optimize. So I will say the profiles, if we have a little bit of all 3 types of money, has some advantage over if we had all of one type of money. Just because even carrying over from like the timing of stuff and those cliff thresholds, right? If Caleb and I are trying to work with a client on keep your income here, well, we don't want to go into the taxable IRA for more money there, right? Can we go to an after-tax account or a tax-free account to really control that cliff, as an example? Mm-hmm. So what else do you kind of see from your end on that, Caleb?
Yeah, another example of why it's so great to have these 3 buckets of money honestly goes back to the charitable idea. Right. So a lot of people come to us and say, hey, I saw that I should convert all of my IRA into a Roth IRA. And again, it depends, but that's probably not always the best idea. And one reason is charitable giving, right? By leaving money in that IRA, that is the perfect money to gift away, right? You can do this qualified charitable deduction, send that money to the charity of your choice. You're not paying taxes on it. They're not paying taxes on it. That's really the best possible tax treatment, right? So by having money in all 3 buckets, that lets us be so strategic throughout the year and decide exactly how do we want to do this.
Right. Yeah. And then moving on to capital gains management, this would particularly just deal with the after-tax investment accounts. And this is always kind of a funny one because we do want our money to grow and make money. But also if we just let it sit and grow, all of a sudden we can get riskier in our investment. So it's always a little bit of a double conversation on risk mitigation, right? To prune things back or to reduce risk exposure or to balance a portfolio back. And in that process, we're going to realize gains. So we do kind of want to understand and strategize around that. If there's losses we can harvest, great. If we can kind of cherry pick things with long-term gains over short-term gains to get a favored tax rate, those are all little things we can do. But it is always that planning sort of, if we hold an investment for too long and it embeds too many gains, then all of a sudden we feel like we can't even touch it, right? So a lot of times we're of the mindset of how do we kind of carefully prune off taxes slowly over a long period of time so we just don't embed that into some asset that we can never touch, which obviously doesn't help our life if we can't touch it and are afraid to pay the tax on it. But what are some other examples of really paying attention to this one, Caleb?
Absolutely. So on a pure investment like stocks and bonds side, we use very efficient funds. So that kind of is what it is, right? We work hard on that. But think of other investments. Think for instance about a rental property. And this is something that a lot of clients have. Let's say that they lived in a home and then they moved, and now their old home, which they lived in for many years, they now decide to rent. And maybe they're going to rent that forever. Great, not a problem. But maybe they don't want to rent that forever. And the tax difference between renting that for 2.5 years and 3.5 years can be enormous. So thinking, hey, what is the right holding period? How do we benefit from all of these rules and laws to minimize overall capital gains tax and some of these like non-stock investments? We even have had situations with gold coins or other things that people have owned for a long time. With the stock side, I'll say is relatively straightforward. But all of these other assets, thinking about how to best use those, how to best realize those capital gains, really can have big tax impacts.
Right, for sure. And then sticking on these non-qualified accounts, kind of the larger they get, the more problematic they can kind of be, and the more attention that they take. You're really creating some big swings. All of a sudden, if there's no tax withholding ability on a brokerage after tax account, right, we've got to factor that into the planning. And kind of going back to those safe harbor things, sometimes it's a little maddening, especially when we start getting multi-million-dollar after tax portfolios that could be up really radically in one year, might be down, and we harvested losses in another year, might be up kind of medium in the third year. And so a little bit of that safe harbor, sometimes chasing these big portfolios of if they had a good year or a mediocre year or a bad year, and can kind of create a little bit of mayhem in the estimates and some of the things that we have to do. But it is just understanding that it is a little bit of the nature of the beast with these large accounts, trying to manage them and what they do over time while being as efficient as possible. But it does create a little bit of a swing effect. And so what do you kind of see in real time on that as well, Caleb?
We see a lot of this is dependent not so much on the client's decisions, but sort of external forces, right? A great example of this was when the Fed has raised and lowered interest rates, right? All of a sudden, certain bond funds started paying either a lot more or a lot less, right, in dividends. And so we had clients who had maybe for years been maybe in this sort of band of income, all of a sudden just spiking, almost doubling, right, because of these interest rate changes. And so just being aware of that, planning for that, helping the client understand, hey, this is what is happening. This is great. It means you're making money, but we need to bump up your tax estimates, or we need to do things a little bit differently in some other aspect of your financial situation to cover these taxes. Just being aware of that really helps the ship sail a little bit more smoothly.
Right, exactly. And then moving on to kind of another piece of this, which would be just how our estate and gifting strategies could be, especially if it's like interfamily in particular, definitely could have large estates, and we might be wanting to lower that threshold just to try to keep, lower in the threshold of estate taxes. How do we pass money along to our children and grandchildren? And so a few little topics on this would be, we can gift cash and stock up to like $19,000 a year per person. So that's one we see quite a bit. Another one is like a 529 super fund. A lot of people like to do this for their grandchildren, and we can actually use 5 years of that 19,000 amount. And especially if we can catch kind of a younger grandchild, right, they're getting a lot of years worth of tax-free growth. And then there's also kind of more fancy techniques like family limited partnerships and family limited LLCs, things that we could kind of move a business or a farm property into an entity and kind of create maybe some estate reductions by using discount values, and generally kind of create a lot of legalese and a lot of professional team expertise to fully execute this, but they are strategies that are out there. And then also just tying back to like the Roth conversions, we've talked a few times about that already. And just that can be a way to kind of leave unused money if we can pay the tax early on it and let it grow tax-free. Right now, we do have inherited Roth IRAs that could let a beneficiary even extend it for 10 more years. So that's a common strategy we see as well. So that's the quick overview. But Caleb, kind of talk us through the details of all of these areas and what you see.
Yeah, and so with these in mind, we sort of have two scenarios, right? So we have the scenario of someone who has, as a couple, more than 24, $25 million in assets, right? And that's a great problem to have. But that means when you have over that 24, 25, million dollar asset park, then you could be subject to estate tax, which is a really high tax. So the question is, if you are in that situation, how do we avoid it? How do we either lower your estate or do other things to keep you out of that tax threshold? Now, if you're under that amount, some of these are still great, right? They're great ways to be able to help your grandchildren pay for college via that 529 super funding. We see a lot of clients do that, a really powerful approach. Obviously, just gifting, either cash or shares using that annual exclusion amount is such a great thing for people to do, not just because it can help lower estate tax issues, but that means you're gifting to family or friends during your life. You get to see them use that money rather than just leaving it to them after you've passed away. And obviously, Roth conversions, another tool that they can be really powerful, especially in a one surviving spouse scenario, right? We think that maybe as a married couple, everything was great from a tax perspective. But when one spouse dies, instead of using the married tax rates, they have to use the single tax rates. And overall, that means their tax, the amount that they pay in taxes will be much higher for that same amount of income. So doing a Roth conversions while both spouses are living can really help the surviving spouse deal with that. And then, of course, the FLP, the FLLC, we could do an hour on those easily. They're really pretty complicated, but for the right scenario, when a family has a lot of money in stock or a lot of farmland or a very big business, these are a great way to be able to share those with family while avoiding a large amount of tax.
Right, exactly. Moving on to some real world examples. The first one is coming back to the Roth conversion, just to paint a little picture of what we commonly see is this ends up being usually a pre or early retirement period decision. Most of the time we see people kind of in their 60s, early 70s considering this, especially if we're in a window where not all the income streams are turned on. Maybe wages have gone away. Not everything's kicked on. We're delaying Social Security. And if we can strategize to say, hey, over this certain amount of years, let's move up to one of those tiers and feel like we can strategically pay the tax. That's definitely a scenario where we model that out quite a bit. It generally is where people are underutilizing some of the portfolio resources, like their lifestyle is controlled on what their pensions or Social Security and maybe a small amount off the portfolio would yield. Because usually that way, we might be able to get tax-free growth on some monies that could grow and maybe get to, like, say, our children or grandchildren in a tax-free aspect. And then also by doing that can reduce the required minimum distributions that they might have when they do turn that age that they have to have that happen. So I would say that's kind of the most common window we see. But Caleb, give us a little bit of your experience on that.
Yeah, that is absolutely the most common window, right? We kind of that gap year. Maybe someone was a real high earner and then mid-year they walk away from their job, right? And now, or they retire. So instead of being maybe in that 32, 37% tax bracket, for this year, they're going to be in that 22 or 24% bracket. And so that's the exact year we say, okay, let's really load up on these Roth conversions. Let's maximize what we can now, just to save you money for years and years to come. The other scenario, we've even done some of these really large Roth conversions in people who have, they have plenty of income, and their whole life they're going to have plenty of income. They'll always be taxed at maximum brackets, but they say, hey, this is an estate idea, or I want to leave money to my children tax-free. So even though I'm, paying taxes at a pretty high rate, I'm still going to do these large conversions because over the lifetime of both me and my children, it will be a huge tax savings. So there can be many different reasons to do these conversions, but especially in this pre to early retirement, it's almost a no-brainer for many clients.
Right. And we do have software that can kind of model that out and give a little bit of what's that look like if we're paying the tax bill today and then it grows tax-free for a long period of time. And obviously, if it's a higher tax bracket, right, less of an advantage, but still tax-free growth from that point on. Mm-hmm. Certainly, if we can capture lower tax rates, even better, right? Mm-hmm. So it definitely can optimize that and feel good about some of those decisions. And then along the way, we do have to also be careful because sometimes we can intentionally move into where we know Medicare premiums would be higher for somebody, but it is a little bit of a baked in cost. Like, hey, this might cost a few $1,000s more, 2 years later when Medicare jumps, but it's still worth the strategy and paying the tax, dealing with that. And then eventually maybe those will settle back down. Or in the example Caleb gave where somebody's high all the time, maybe it'll just be a really high Medicare table no matter what. But at least making sure people are informed and kind of know all the little pieces that would go into that equation, but still could be worthwhile tool to really optimize tax-free growth over a long period of time.
Yeah. And again, these are so popular online. Everyone talks about the importance of these. And in the right situation, that is absolutely correct. But it's important to plan for them. If you just execute them without thinking about it, you can actually kind of cause more trouble than they're worth.
Right. And we do need to have the after-tax money in a different account generally to pay for the Roth conversion. So got to be the right profile and right discussion for sure.
Yep.
So moving on to our example 2, the high income year. This could be, some kind of liquidity event or selling something that created a long-term capital gain. Could be some inheritance that triggered taxable income for part of the inheritance. Could be just a windfall salary or bonus. But this is definitely an example of when we do have those kind of triggering events, kind of like some of the past points in this presentation, what kind of things can we utilize through the year to really try to offset that to as much as we can, right? Can we max out deferred plans? Can we do a donor advised fund to create a large charitable deduction? So we're really just trying to use those tools to kind of say, hey, through the year, if we're really seeing an anomaly or something big happen, are there ways we can kind of find things to offset that? So Caleb, your take on this one?
Yeah, we do a lot of these donor advised funds, and clients across all sort of profiles can benefit from these. But I think some of the coolest ones we've done have been when people have had either large business sales or an extraordinary equity comp year, right? Where all of a sudden, maybe their income is usually 200-300K, and this year it's $5, $7, $8 million. And this, it's a one-time event, but wow, this massive year of income. And they've said, hey, yes, this is, this is my big break, but I also want to give some of this to charity. And then so they use these donor advised funds where they might plug in a couple 100,000 or more. We've seen some really large ones into these funds. And that's the money they will use for charitable giving for years, potentially decades to come. And it becomes not just something that they appreciate, but it becomes a family project because they know these are funds that are earmarked for charity. So then they get involved with their children or their family to decide, hey, what are we passionate about? What do we want to support with our money? And then so for years to come, they can benefit from this fund and really enjoy their charitable goals.
Exactly. And then moving on to example 3, just diving into that overlooked harvest, one more time. This can also be an example with that high income situation where if we could go look in the portfolio and maybe find a loss that could offset just to create some betterment. But Caleb, your take on the overlooked harvest?
Yeah, again, this is something you have to do in the calendar year, right? So without proper planning, you could easily miss this. But it's great when something drops either suddenly or there is an odd market turn where perhaps a whole fund just drops 10, 50, or quite a bit. That is a great opportunity to say, hey, let's capture that loss. We'll follow the IRS rules, kind of move it out of that fund into something similar but different enough. Then we can move it back after enough time has passed. So we're not really losing any money. We're just creating that loss that helps offset other income. But again, this has to be done in the calendar year to benefit from that.
Right. And the problem is we can't control markets, but I know with our strategies, we do try to watch out and be opportunistic when they do show up, right? We can't guarantee in a year somebody has high income, we can find a loss to offset. But when they do kind of happen sporadically, if we can jump on that and swap to a different fund and capture that loss, we're going to try to do that to even offset somebody's normal situation, let alone a high income year. But the one problem here is they're very opportunistic and they don't come around all that often to just say, oh, we can guarantee doing that when somebody's trying to lower their tax burden.
For sure.
And then moving to example 4, this is definitely one I commonly see. And when we really get high income earners, and especially as Caleb likes to describe, say they creep there over time, and you started out at a modest salary and really ramped up and got some raises and promotions and moved to a high salary, or even doubled the effect because your spouse also was doing the same thing. And say it got to a level where now I'm getting larger cash bonuses or stock incentive bonuses. And really, when we rely on like standard withholding tables, I think this is a very commonly overlooked one. And I had everything set with payroll, but it didn't take into account for the bonus, or the bonus and the salary, right? It did the salary for most of the year and then did a withholding on the bonus, but combined that wasn't enough. Or same thing when we throw in our spouse's income and bonus, it wasn't enough. So this is where sometimes proactive planning on tricking the systems, setting the payroll withholding to be more aggressive, sometimes even doing additional dollars specifically withheld to tax, or jumping in on the bonus and saying, hey, let's do a projection, and the standard bonus withholding wasn't enough, let's send in an estimate for that quarter and do extra, so you can really get down to net of the money, and then also more importantly have enough taxes paid in and not be surprised or having like underpayment penalties. But Caleb, you've seen this quite frequently as well with me, but very common one.
Yeah, definitely. And we see this across many different, I'll say, levels or thresholds of this. Definitely, even when someone receives a $50,000 bonus, that can be withheld at a frequent standard rate of only 22%, but they might be in the 32, 35, 37% tax bracket. And they think, hey, look at this, I got $50,000. Well, yes, but you're going to owe 15 of that even in taxes. So don't go spend that immediately. And even had an example with someone receiving 1.5 million in equity comp. Awesome. They were very excited about that. It was like, well, wait a second. They withheld nowhere near enough. You're going to really owe another about $300K in taxes of that. So still, you're walking away with 1.2 million. That's fantastic. But once you realize what the tax benefit is or what the actual net amount of your bonus is, well, hey, great. Then you know what to do with it. But if you had gone and invested, spent, done something else with that, then come the end of the year, having a $300,000 tax bill would have been a pretty big shock.
Right. This one can be a big surprise, right? Because if people are under withholding on their salary, then they wonder, why did all of my bonus or most of my bonus go to taxes? It's like, well, you had to make up for also under withholding on a whole bunch of your salary as well. And so that can be, frustrating to feel like, oh man, most of my bonus went to taxes because of, not really trying to level that out with all the rest of the stuff going on in the household.
Yeah,
so
absolutely.
Very common one to stay on top of that, send us pay stubs, send us bonus statements, and really be proactive with projections and withholdings through the year.
Yeah,
so this definitely takes a two-way relationship to pass along the information so we can stay on top of it. So wrapping up here with key takeaways from reactive to proactive, taxes themselves aren't the problem. The absence of strategy is. We've definitely highlighted a lot of that today. And the best time to plan is throughout the year, not just after December 31st when all the documents come in and we can throw them at our tax preparer. And then tax planning and financial planning work best when they're integrated. So you can definitely see how myself and Caleb have done this quite frequently and really can both kind of see this from a good lens with clients from the planner and the tax side, but a lot of strategy and really syncing that up, having that collaboration and working together throughout the year. And then we know small intentional decisions make consistently and compound into significant savings. So just all those little tiny things can add up and help us reduce those liabilities. And you won't have to navigate this alone, right? Partner yourself with a great professional team. And really that's what professional teams are there for. It's certainly what we're here for clients. We want that to be a service people use and plug into ongoing to make their life better and create less surprises. So with that, Matt Sievertson, this is Caleb Erringdale. We will move to our question and answer part of the presentation.